Hey guys, Tim Melvin coming to you from down here in Southwest Florida, where we've spent the day getting the Community Bank Stock Investor Monthly Edition ready to go into publication. You should have that fairly early next week. And we spent a lot of time dealing with laptop malfunctions and trying to figure out how to get the lighting right to offset the fact that it's a very dreary, gloomy kind of day down here in Southwest Florida. It's very chilly. Actually, had to break out a sweatshirt for the first time all year. Not real happy about that. I'm going to be real happy to see this cold front go ahead and get on out of here later this week. Not a fan of those super chilly temperatures when I'm walking the dog out there early in the morning. Hasn't really warmed up all day, so not a fan. Be gone next week. I'll be much happier about everything. Um, anyway, conversation with some folks the other day, and then this topic of bank stocks and some of the other strategies that we use came up. And the question is, why bank stocks? Nobody cares about bank stocks. Why are you recommending and suggesting bank stocks? Here's the reason, guys. First off, I've made a lot of money in bank stocks, obviously, over the years. But when I look at the broader question, okay, why bank stocks and private equity replication strategies and all this stuff that nobody's ever heard of and nobody else really does, closed-end funds and real estate investment trusts. My goodness, they're ridiculously boring. They're for old people and grandmas, right? Well, here's the way this works. Charlie Munger brought this up a few years ago at the Daily Journal uh, annual meeting. We said, look, if you were trying to outperform the market today with a larger sum of money like a fund manager, you can't do it. The markets have gotten way too efficient. Seth Klarman later elaborated on that in a shareholder letter when he said, look, we've all got the same computer databases, we've got the same analytics programs. Everybody kind of went to the same school to learn how to do this goofy stuff called picking stocks. So it's going to be very hard using traditional strategies to gain meaningful, lasting outperformance, unless, as Munger said, you're willing to go look into the illiquid, inefficient areas of the market where nobody else is spending any time. So that's what we do. We've been able to identify that there's four things that, as retail individual investors not managing tens of billions of dollars, you and I can do to gain lasting outperformance. One is community bank stocks. They're very small. There's very few institutions playing in the space. Those that are active tend to be willing to take an activist approach to investing, and we can just coattail right along with those guys when they take in a position in a bank stock that meets our criteria. The other thing is closed-end funds. Closed-end funds trading at a discount. Gee, sounds super boring. It is actually, but it's also super profitable. And again, there's known activists in the space that if you want to add a little zip to things, you can kind of ride their coattails. And are you going to hit a 10-bagger in a closed-end fund? No, but you're going to be able to consistently generate above market returns. And as we'll talk about in a minute, that's going to be ridiculously important over the next 5 to 10 years. You're going to have to outperform the market, or you're just not going to make a lot of money. REITs, they're a little bit institutionally overowned right now because specifically of exchange traded funds, but there's a lot of REITs that are not in the ETFs. They're smaller in size. You can buy them at a tremendous discount to net asset value, collect very high dividends, and wait for the net asset value discount to go away. And you hit a 10 to 1 shot in REITs. Well, yeah, you can. It's just going to take a long time. I've talked about it before. There is one particular real estate oriented investment that I own. I intend to own it forever. It's got very high yields. You're only looking, a high teens total return year in and year out. At that rate, you can get very, very rich. If you're impatient, use a little margin, but then of course you do ramp up the risk quite a bit. And then the other thing is traditional value investors, you're taught from day one, avoid leverage because Warren avoids leverage, and we've all got to do what Warren does. So nobody wants to buy these leveraged smaller companies that trade at low multiples. So I like to buy those because that's exactly how private equity funds have made their investors richer over the years. They take small companies, pay low multiples, and pile the debt on. Then it's the debt pay down, the debt buyback and reduction in debt year by year by year that actually builds value in the underlying company. So it's a very simple idea to find a bunch of these companies that are leveraged to the point where most value investors want absolutely nothing to do with them, but they actually pass the credit scores and they're actively reducing debt quarter over quarter, year over year. You can make a ton of money in just that strategy. Now, using these four things, history tells us we can beat the market by a pretty wide margin. That's going to get critically important. We've talked about forward returns several times. Robiati and Company just came out with their projection through 2024 of returns for various asset classes, and it's not pretty, guys. No asset class, with the exception of commodities, is expected by this firm, a very respected firm, to return over 5% a year. And commodities, by the way, is only about 5.4% going forward. With multiples where they are, earnings multiples are very high. The CAPE ratios and the Tobin's Q ratios are off the charts high. With equity prices at those levels and bond yields where they are, it's just real hard to run any type of classic portfolio mix of stocks and bonds and expect to do well. In fact, if you use Bogle's projections and Robiati's, you do a 60-40 mix of stocks and bonds, and you're probably somewhere in the threes as far as your total return for the next 5 to 10 years. Now, if you go by GMO Asset Management's projections, you're going to lose money with that exact mix. So, yeah, you can buy all the low cost index funds you want. If the returns aren't there, they aren't there. And I don't think that they're going to be there for at least the next 5 and possibly the next 10 years. Now, I don't know what path, and I talk about this all the time. Low returns can take several paths. We can have a crash and slowly recover. We can have a melt up, which is what a lot of people think is going to happen. We'll have a big melt up here and then come back down to current levels and maybe even slightly below them. Or we could just churn around in a range bound market for an extended period of time. I don't know how we get to the lower returns. I'm just pretty sure lower returns are what we have in front of us. So we've got to be actively looking for a way to beat the market by a pretty wide margin. We have major advantages when it comes to illiquid companies. We need to be using them. Not owning community bank stocks is just ridiculous. I don't care how much you want to own the exciting technology stocks and the exciting healthcare stocks. You're not going to make as much money with those just because of the competition from larger investors willing to pay higher multiples, knocking down future returns. Community banks, we can go in there, guys. We can buy these things at a nice discount to book value. We only buy banks, by the way, that have really good loan portfolios and really strong balance sheets. We're not betting on any turnarounds here. Learned my lesson about that a long time ago. We buy healthy banks when they're available at a discount to book value, and we just sit back. The only way for the larger regional and community banks to gain growth in a very low growth world is going to be to buy their competitors. So one of two things happens with our small banks. Either they're going to buy even smaller competitors and grow their asset base so they can gain the scale needed to deal with things like technology costs, regulatory costs. That will get the stock price higher. It's just as likely that somebody else is going to come along and say, okay, there you are, you're trading for less than book value. We're going to pay you a premium to book value and add your bank to our bank, take out about 30% in costs, and we'll grow our earnings that way. Not owning community bank stocks, especially when you can buy them at a significant discount to book value, is just biting off your nose to spite your face. You're doing what everybody else does, buying the low cost index or chasing the hottest stocks. Doesn't matter which one it is, for the next several years, it's probably not going to work out very well for you. So you got to look at some different ideas. Now, that brings us to, where are we? We're just about done for this. It's just going to be a quick video. We've spent all day playing laptop repair after we got the community bank letter ready to go into production. So my book recommendation this week, I think you're really going to like it. It's called The American Story, Conversations with Master Historians. David Rubenstein from Carlyle, the private equity firm, actually used to do a series of interviews at the Library of Congress that was only for members of Congress. They were interviews with historians who studied some of the leading figures of American history: Washington, Jefferson, uh, FDR makes it into the book. Ronald Reagan is, of course, in the book. So is Kennedy. So is Lyndon Johnson. A bunch of the founding fathers. And just fascinating transcripts of these conversations and interviews they had talking about figures of major importance in American history. It is a wonderful read. I highly recommend it. The proceeds, as I understand it, are going to charity, so you're not just putting more money back into Mr. Rubenstein's pocket. So anyway, that's about it. College football season just getting right into that final stretch. Navy got blasted by Notre Dame yesterday, unfortunately, but we are definitely looking forward. Navy's got a chance at the conference title, and we're also highly anticipating the Army Navy game coming up here in a little bit less than a month. So that's all we've got going on down here, guys. I just really want to urge you, whatever you're doing, step back, take a look, consider investing in community bank stocks, read to the discount to net asset value. Same thing for closed end funds. And if you're looking to aggressively pile up total returns over the next 5 to 10 years, I think your best possible bet is going to be a combination of a private equity replication, highly leveraged small company stocks, and community bank stocks that are takeover targets. Anyway, going to try to get these out at least once or twice a week. I apologize for the horrific lighting down here. It's blame the lack of sunshine that we're experiencing down here in Southwest Florida. And one final note: last night, the wife and I went up to Fort Myers to the River District, and I had never been there. Got to tell you, if you're ever in the area, get down by the riverfront. There's some great restaurants, fantastic clubs. We found a cigar bar where we could kind of hang out and smoke cigars, and there was a rooftop bar down there that looks out over the rivers as far out as the Gulf of Mexico. So just a very cool place to spend an evening. We found some great spots, and we'll be going back again soon. Maybe we'll run into you there. Anyway, I'm Tim Melvin. Nice Sunday afternoon to everybody out there, and I'll talk to you guys later this week when I get the laptop and this ridiculous lighting fixed just a little bit better than it currently is today. Hope you enjoyed it. Thanks. Bye.